Think of the economy as a patient with a raging fever that's inflation. The Fed is the doctor, and their main medicine is raising interest rates. The idea is that a higher dose of interest rates will cool things down. When money becomes more expensive to borrow, both businesses and consumers get more cautious. It's like putting the economy on a temporary spending diet to try and tame the fever of rising prices. Here's where things get tricky. While raising interest rates can be effective, it's a bit like using a sledgehammer to perform delicate surgery. The Fed's goal is to bring the fever inflation down without killing the patient, the economy. Too little medicine and the fever rages on. Too much, and you send the patient into shock. That's a recession or worse. The Fed's main tools work on demand. They make it less attractive to spend money. But a huge chunk of our current inflation problem is supply-side global shipping bottlenecks. The war in Ukraine impacting energy markets, continued effects of the pandemic. It's as if the patient isn't just feverish, but they've got a broken leg. And the only treatment the doctor has is fever reducers, and Fed can't magically fix those underlying supply problems. This is the million-dollar question in 2024, that how much economic pain will it take to bring inflation down? Think about it like a seesaw. On one side is inflation, on the other side is the health of the overall economy. In a perfect world, the Fed can gently lower the inflation side without causing the economy side to crash down. But the risk is that we're in an unbalanced situation with lots of supply issues, and to compensate, the Fed might need to create an intense recession to finally cool down demand that's been outpacing supply for a long time. Imagine a massive traffic jam stretching for miles. Cars are barely inching forward and everyone is frustrated. This is kind of like our current inflation situation. The cars are the goods and services we want. The road is our supply chain. Factories shipping all the ways those goods get to us. Pre-pandemic, the road was wide open. Now it's full of bottlenecks. This creates a shortage, causing prices to surge. The Fed's main job is to keep traffic flowing smoothly. The problem is their best tools are toll booths. They can raise the price of borrowing money, trying to get some cars to exit the highway, businesses delaying expansion, consumers holding off on big purchases. It's the economic equivalent of intentionally slowing traffic down, but that won't fix the supply-side issues like a worker shortage, slowing down a factory, or a lack of shipping containers to bring in imports. The question is that how much does the Fed need to choke off traffic? Cause a recession to reduce demand enough to compensate for the limited supply? Imagine if, to solve our traffic jam, the solution was to ban half the cars from the road entirely. The jam would ease, but at enormous economic cost. This is the debate economists are having. Can the Fed cool down inflation without triggering a severe downturn? The optimistic scenario is called a soft landing. This means the Fed slows the economy just enough to take the edge off inflation without sending things into a tailspin. It's like finally reaching the end of the traffic jam, easing up on the gas, and starting to move at a normal speed. But the hard crash scenario is also very real in 2024. If the Fed misjudges, we might end up slamming on the brakes, causing not just a slowdown, but layoffs, business failures, and a stock market plunge. The whole economy could end up stalled on the side of the road. Economic history doesn't give us a crystal ball, but it does offer some unsettling deja vu. Think back to 2018. The Fed got confidence, steadily raising interest rates throughout the year. Markets, which had been enjoying years of easy money, did not take it well. The last quarter of 2018 saw a nasty stock market plunge, reminding everyone that there's a limit to how much tightening the economy can handle. The key part is what happened next in 2019, spooked by the market's temper tantrum and signs that the economy wasn't as strong as they'd thought. The Fed reversed course. Not only did they stop raising rates, they actually started cutting them again later in the year. It was a rapid about-face that highlights just how quickly confidence can turn into fear. Flash forward to 2024, the Fed's in a familiar position, determined to tame inflation via rate hikes. Investors, remembering how the last round of this played out, might be hoping for rate cuts later in the year. But what if we're misreading the signals? In 2018, the market sell-off was the wake-up call the Fed needed. What if that moment of panic hasn't yet occurred in the current cycle? The lesson of 2018 should act as a warning in 2024. Don't assume that the current market optimism about rate cuts is justified. The The Fed might be forced into repeating its policy reversal, but until signs of serious economic pain start flashing red, it may well stay the course with those rate hikes. History doesn't repeat, but the rhyme scheme suggests that a rough patch might be on its way. Think about rate cuts like a powerful medicine with severe side effects. It's not something you want unless the economy is in serious trouble. If the Fed suddenly reverses course, slashing interest rates in 2024, it's like hitting the panic button. They've concluded the economy is headed off a cliff, and harsh medicine is the only way to stop the fall. Normally, falling interest rates are good for stocks. It means easier borrowing, more investment fuel for the market to rise. But if we see sharp rate cuts out of the blue in 2024, it's a sign that the Fed is more afraid of a severe recession or even worse, deflation. Deflation is like quicksand for the economy. Instead of things getting more expensive, inflation prices start falling because no one is buying. Why is falling prices a disaster? Imagine you're thinking about buying a new TV. Prices have been rising with inflation, so you figure you might as well buy now. But in a deflation scenario, you think, why buy it now when it'll likely be cheaper in 6 months? Everyone starts thinking this way. That means businesses can't sell their goods, so they lay off workers. This creates a vicious cycle. Fewer people with money to spend, prices falling further, more job losses. Soon the whole economy is spiraling downwards. Imagine deflation as a whirlpool dragging the economy downwards. When prices start falling, it creates a dangerous feedback loop. Consumers hold off on spending, expecting things to get cheaper. That means businesses end up selling less stuff and for less profit. Companies start feeling the pinch. This is the first blow to the stock market as investors realize that earnings, the lifeblood of stocks, are set to plummet. Companies facing a shrinking market make desperate moves. They might slash prices further, hoping to sell something, anything. They might resort to layoffs to try to cut costs. All of this reinforces the deflationary spiral. Fewer people have money to spend, prices fall further, leading to more business desperation. Meanwhile, investors sense a coming disaster and start dumping stocks, leading to a market sell-off. This is where rate cuts come in, but as a desperate measure, not a cause for celebration. If the Fed slashes rates in 2024, it's not because things are good. It's a sign they're panicking about the crashing economy. This fuels the stock market crash from two directions: the fear of deflation itself and the realization that the usual tools to bolster the economy, low rates, might not be enough. Historically, major stock market declines like this usually coincide with deep recessions. The economic pain becomes widespread. Lost jobs, bankrupt businesses, a general sense of uncertainty. This leads to even less spending, creating a vicious cycle. Deflation is a symptom of a severe economic illness, and the prospect of it sends a legitimate chill down the spines of investors. Imagine the Fed as a firefighter tackling a raging house fire. That fire is inflation, their main weapon. Raising interest rates is like a giant bucket of water. The goal is to douse the flames without flooding the entire house and ruining everything inside, destroying the economy. This is high-stakes work, and using too much force will do more harm than good. The Fed desperately wants to bring prices back under control, but doing so runs the risk of seriously damaging the economy in the process. Think of it like a patient with a very high fever. We need to bring that fever down, but if we crash their temperature too quickly, it might cause organ damage. This is the economic equivalent. An overly aggressive Fed could send the economy into shock, causing a wave of job losses, widespread business failures, and a stock market collapse. Here's why it's so hard to predict the Fed's next move. The economic data is sending mixed signals. Take the jobs market. We've seen recent reports of unexpected strength, with unemployment numbers remaining low in 2023. This might suggest the economy can handle those higher interest rates. But then you look at other indicators: consumer spending starting to weaken, housing market activity slowing. This points to the possibility that the economy is a lot more fragile than those positive headlines suggest. The trillion-dollar question, really. In 2024, will the Fed risk erring on the side of caution, slowing things down gradually, or will those fear of runaway inflation make them take drastic action? Could economic indicators weaken so dramatically that they reverse course on rate hikes entirely? It's the economic version of cliffhanger TV, where the consequences impact every single one of us.